Yeah, I think this thing's getting close to broken. I mean, really, this rally has been absolutely phenomenal, but trees don't grow to the sky. And I think we're going to start to see something getting a little more shaky. Hey, everybody, Courtney Smith here with TradeSmith, our weekly video newsletter for Monday, February 27th. And more important than anything I can say is that you read this, understand it, and just totally enjoy it. Now, S&P 500, look at that, 2 straight weeks skyrocketing. Purple predictor, bullish. That chart looks fantastic. Dow Jones, a little bit shakier. Look at our DI plus is really going sideways now. Even though the price is going up, we're starting to see some internal weakening of this upside momentum. So not that we're going to sell off this week, but we'll probably sell off sometime in the next couple of weeks. A normal correction, no big deal. Down a few days, down 2, 3, 4%. I'm not talking about even a 10% correction. Here's the NASDAQ, got hit a couple of days, but then had a reversal bar to the upside over there on Friday. So got back on track, looking good. Now, our seasonality, we broke to a new high, and I told you I wanted to go to even larger positions than normal. But you can see that we faded late in the week. And now a little bit strength on Friday, but still not that great. So I'm going to stick with my position of having extra large positions. It's still a bull market here. So our seasonality indicator is bullish, maybe even super bullish. Seasonality, I think we've gone over this. We're in the middle now. We're in February. And the blue line is the most preferred line, which really kind of says we're going to go sideways until April. And then we're going to have a nice big rally. I'm going to stick with that scenario. Sounds pretty good to me. The yield curve is turning somewhat positive. This is from a year ago. Excuse me. And you can see that some of the pressure has been released that has been holding down the bull market, but where that yellow line is shows that it's actually going to be releasing that pressure over the near term. Asset allocation has moved to a bullish stance. That means that money's flowing out of the bond market and into the stock market. Our Riskdicator, though, is showing that they're going more and more, the market's going more and more towards conservative stocks. And this is kind of one of the things that I'm a little bit worried about. Normally, excuse me. Normally when the market is, excuse me, really bulling higher, normally you see that they want to take more risk, but they're really running for the hills. Excuse me, 1 second again. Wow. Okay. Sorry about that. Global shares looking very, very good. Not as strong as the U.S., but looking still very good. Don't really want to play it. Still prefer to be in the Japanese shares. We had a breakout in the last couple of weeks. And the only thing is that the dollar's been weak against the yen. So this particular ETF, DXJ, hasn't done as well as it could. But I think that's going to reverse itself. So I'm still like being long DXJ. Bonds, look at this. We're stuck in this trading range here where we accelerated towards the top of the range, which would be lower interest rates. Purple predictor, still negative in my mind, although not as negative as it was last week. Our indicators here are still, let's just go through them. The green line is the 10-year Treasury yield. And you can see it's been coming down recently. That's the yield, not the bond price. But you can see the gold line, that's the price of gold. It's going up, which suggests higher bond yields. Then the chart itself is kind of going sideways. That's the CRB index. It's going sideways, so it's saying, well, interest rates ought to be sideways. And then the blue line, which is the most important one right now, that's 10-year Treasury note yields in Germany. And you can see that they've actually started to come down, and that's what's helping to pull down the U.S. interest rates as well. So our indicators now are kind of, one bullish, one bearish, and one neutral. And so I think we have to say, let's go back over here, that this sideways trading range is probably about what we should do. Just stabilize near these levels. So really no big trading opportunity here. Okay, let's carry on. Let's talk about the dollar. Now, you know, I've been bullish on the dollar. We had a couple of weeks where we saw it rally there. We're kind of going sideways right now. I think largely because of interest rates are going sideways. So one of the most bullish factors affecting the dollar is kind of like not that bullish right now. It's neutral. So I still like the long side of the dollar. The U.S. has the strongest economy, the tightest monetary policy, the best interest rates. So I still like the dollar on the long side. Gold, now here's the interesting thing. Gold's been doing very, very well. As the dollar kind of staggered, gold kind of took off. Now, I think the place to be is not gold, but silver. I'm personally long silver right now and feeling no pain. So I like silver better than gold, but precious metals, they're going up. I don't have a position in gold. As I say, I have a position in silver. I think those more industrial metals are going to do better than the pure precious metal. Our gold short-term indicators are kind of a mixed bag. What can I say? Oil, a little bit of strength here, but we still have yet to break out to the upside or the downside. So for me, better to stay on the sidelines until we get a clear trend. I only like to trade things that are clear. Why should I fight the market? All right, everybody, thank you very much, freebies, for hanging out. All of our faithful podcast listeners, thank you very much for voting our podcast with 5-star rating. We really work hard to give you insights into the market for absolutely free so that you can make some money here. All right, fully paid up members, hang in there. Got new stuff for you. Talk to you freebies later.